You're listening to the Unlocking Africa podcast.
I grew up in Denmark and made my first way to the continent in 2007. I moved to Kenya, been a Kenyan resident since 2009. What people often forget is that before mobile money, most people on the continent still didn't have access to traditional financial infrastructure, still didn't have bank accounts. I think particularly stablecoin is going to fundamentally change the way finances is done on the continent. Remittance has come up really fast. That's one of the big things that has fundamentally shifted on the continent in the last 5 to 7 years is the rise of remittance payments directly into people's phones.
Stay tuned as we bring you inspiring people who are unlocking Africa's economic potential. You're listening to the Unlocking Africa podcast with your host, Tessa Adamu.
Welcome to another episode of the Unlocking Africa podcast, where we explore the ideas, innovations, and execution strategies shaping Africa's economic future. Behind every trade flow, every remittance, every digital marketplace, and every growing African business, there is one critical layer that determines whether scale is possible. That is payments. Across Africa in 2026, mobile money is no longer just a consumer convenience. It is settlement infrastructure. It is liquidity infrastructure. It is cross-border infrastructure. And the question is no longer whether mobile money works. The real question is whether Africa can turn fragmented national systems into truly interoperable continental rails. Joining me today is Nikolai Barnwell, CEO of pawaPay, Africa's largest mobile money PSP. Through a single API integration, pawaPay connects businesses to mobile money operators across 20 markets, facilitating millions of transactions daily and settling billions in payments across the continent. Nikolai, welcome to the Unlocking Africa podcast. How are you?
Thank you. Big fan of what you're doing, so excited to be chatting to you today. I'm doing very well, thank you.
Fantastic. Thank you for that. Really appreciate it. As always, I like to start from the beginning. Can you give us a brief introduction into who Nikolai Barnwell is?
Originally a Danish citizen. I grew up in Denmark and made my first way to the continent in 2007. I moved to Kenya permanently in 2009 and has been a Kenyan resident since 2009. So been very lucky to be on the kind of front edge of the mobile money revolution as it happened, and then mobile money kind of closely following that. Started in Kenya with an investment fund back in the 2010s called 88 miles per hour, where we spread out and did about 50 investments across the continent. Had a base in Kenya, had one in South Africa, and had one in Nigeria, and then went on from there into various different enterprises. Some worked so well, most of them didn't work at all, but learned an enormous amount, and then ended up building a sports betting company called BetPower that became fairly large. And from that, we started running into payment challenges, and that kind of became the genesis of pawaPay. We were looking for operators that could help with the quite unique payment challenges that exist when you try and scale a consumer business on the continent across various countries. Didn't quite find any operators that could deliver the kind of quality and the kind of product that we were looking for, and then started building it in-house. Then realized quite quickly, actually, this is a business that should stand by its own. So we didn't quite spin it out. It was not quite a spin-out. We set up an entirely new business, but because the old business was mostly friend and family funded, we took a lot of the early, took a lot of shareholders over and mirrored the table quite closely. And that's kind of the genesis of how I ended up in pawaPay.
Fantastic, Nikolai. You've given us a great overview in terms of their history and your professional experience. I guess that's brought you to what you're doing today at pawaPay, where you are in a unique position in the African payments ecosystem, processing millions of transactions over 20 markets. So from that vantage point, what would you say are some of the most significant shifts you're seeing in how mobile money is being used in Africa today?
One of the big shifts that we really saw was how first mobile money just completely transformed people's access to financial tools. Like what people often forget is that before mobile money, most people on the continent still did not have access to traditional financial infrastructure, still didn't have bank accounts. So before mobile money, very basic things like even saving money meant putting cash in a drawer or in a mattress or something. And things like sending money meant putting it in an envelope and sending it on a bus or sending it with a courier across the continent if you needed to send some cash to a relative in the other end of the country. Without digital tools and without access to traditional financial infrastructure like traditional banking, many of the interactions we have with money and we take for granted in a more digital world and a more privileged world are purely based around cash. And that obviously has huge issues. So what we saw at the beginning with the mobile money rising first in East Africa and in Kenya particularly was just how there was this insane demand pull for some service that allowed people to have access to these very basic services, very basic financial instruments, saving, transferring money. And what was quite cool was because we saw how that evolved in Kenya, then we saw it pop up in Zambia, in Tanzania, in Uganda, and you could kind of just like phase shift the development a couple of years, and we started noticing these patterns. It was like, when the ecosystem reaches this and this number of users, this and this tends to happen next, and it will tend to look like this and this in 2-3 years. So we started to be able to recognize the development of the mobile money infrastructure across the different countries and kind of more reliably predict, okay, where is this heading and where is this moving? So we saw it from pretty much being a Kenyan thing, very sparsely successful across the continent in the early 2010, to the complete behemoth it is today, where today for hundreds of millions of people, mobile money really is not only the primary, but often the only interaction with the digital financial infrastructure of the world. So we've seen that. I mean, today there's more than a billion mobile money wallets on the continent and $1 trillion flowing through the system. So it's not like a niche infrastructure somewhere. It's really the core financial infrastructure for most people on the continent.
You touched on the development of the infrastructure in different African markets. I know we're often guilty of talking about Africa as one market, but from your data, what would you say are the differences in the payment behavior, say, from region to region, West, East, North Africa?
First, I should say that I'm very limited in my knowledge to the area that we operate in and where my expertise kind of is. Like, we don't operate at all in North Africa. So for us, North Africa is a very different financial infrastructure. There's kind of reasons for why. It's very cash-based. There's some deeper card penetration, but there's not really a mobile money as we know it from the rest of the continent in North Africa. South Africa is also very special. It's very card-based, sort of decent banking penetration, but also quite cash-based. And obviously, a country like Nigeria has its complete own kind of classic financial infrastructure that works very different from, say, even a place like Ivory Coast or Cameroon. But actually, the payment behavior in the mobile money space, what we see is very similar across the different markets. Again, it's such basic infrastructure that you give people access to. You give people access to a way to store financial value in a different medium than cash and allow them to transfer in between each other and buy goods and services with that. And that behavior is quite similar. What is a bigger difference from region to region is kind of where the evolution that they are of mobile money adoption. So we see quite early there's a lot of mistrust. People take this, like in the very early phases of mobile money adoption in a country, the trust with the brands, the trust that money is there on your phone isn't there. So what will happen is if you send money to somebody, they will immediately go to the agent and take out the cash to make sure that the cash is safe. And then slowly over time, it kind of evolves and they kind of realize, actually, the cash is saving the mobile money infrastructure and I can send it to other people. And they start to build more and more of their financial management on a household level around the mobile money infrastructure.
You highlighted something interesting there, which is that trust was a hurdle that you had to overcome. Were the specific steps that you had to take to ensure that there is full traceability and build trust with new customers?
So this is something that happens more at our partners levels. So the way where we fit in the infrastructure is in Kenya, for instance, you have Pesa with Safaricom, and you have Airtel money. In Uganda, you have Airtel and MTN, and so on and so forth. So all the countries will have different wallets. In West Africa, you have Orange Money and Wave. And we connect to all the different wallet operators and make it easy for merchants to interact with the entire financial infrastructure. So if you're coming from Kenya and you want to build a Pan-African business, you really need to take mobile money once you get outside of Nigeria and South Africa. Otherwise, there's no way that you're going to be able to connect with your customers. So you need to take mobile money. But now every country has a number of different mobile money operators, and there's 54 different countries on the continent. So there's a huge number of different jurisdictions you have to cover. So we make it easy for merchants to kind of just plug into one API and then get access to the entire financial infrastructure rather than having to go and make all those integrations individually. So the trouble of building trust is more something that the wallet operators they do. So M-Pesa is a good example. The ones that had to do it in the beginning probably took the brunt of the responsibility and burden of developing trust in mobile money because it's brand new there. So obviously it takes a lot of time. You need to be very present on the ground. You need to have large agent networks. You need to slowly make sure that people kind of understand that you're not a scam, that the money is safe with you. If you put it in the infrastructure of the wallet operators, that it will be there when you need it. When you need to take it out, the cash is actually there. So that takes an enormous amount of resources and trust. And Wave is the last one that has kind of successfully built up that type of infrastructure in West Africa, and they've spent hundreds of millions of dollars. And I mean, they've done a really exceptionally good job, but it's very tricky. Many people have tried unsuccessfully to build up competing wallets and kind of realize that it is actually something that is very difficult, especially because it's hard to build trust at a large scale. It's people's money. They need to make sure that it's safe.
As you mentioned, pawaPay offers a single integration connecting multiple mobile money operators. Why would you say this aggregation or integration is still such a critical layer within Africa's payment stack?
So for listeners from outside the continent, I can try and explain it like with an analogy from Europe. So imagine if there is no card rails. Most people are quite used to thinking of card rails when they think of digital payments. But imagine if there were no card rails, so there's no Visa and there's no MasterCard. And you're a business in America and you want to expand into Europe. Well, how would you do that? You'd have to go to Portugal, and then you'd have to find all the banks in Portugal. You'd have to go and knock at the door at every single bank and find the guy on 4th floor that does the tech, and then ask if you could please get some API documentation as you can understand how the system operates. And then you need to make that integration. And then you need to go to the next bank and you need to repeat the same. And you need to repeat that for every single bank in the country. And then you need to go to the next country and you need to do all the same. If the card schemes and the card rails weren't there, that's the way that you would interact with people's financial infrastructure. And mobile money is a little bit like that because it lacks the kind of central switching scheme, the central equivalent to a card rail. So if you are, it doesn't have to be an international non-African merchant. It could also be a merchant from, again, say Kenya or Nigeria. But if you want to interact with the broader African continent and the broader African markets, you need to go and do an enormous amount of individual integrations, both with banks and mobile money operators, to be able to reach a large enough scale. Let's say you just go to Orange in Cameroon. That alone is not a big enough market. You need to cover all the operators in Cameroon. And then you need to go to DRC and you need to cover all the operators in DRC. And then you need to go to Uganda and you need to cover all the operators in Uganda. Because individually, these markets are still quite small, but aggregate, it's a $1 trillion market. So when you can collect and you can access all of them through simple financial infrastructure, you can start to then get a scale that makes it simpler and easier for entrepreneurs to build scalable businesses. But if you have to go and do every single one of those integrations, I mean, of course, it's possible, but it's very costly and it's very expensive. And for most businesses, that's not their core. Their core is delivering the service that they set out to deliver, and payments is just something that ideally they would never have to think about. So that's the role that companies like us step in to fill, is to take that burden away so they can think of serving their customers in what they do well.
You've detailed the importance of the integration, but what would you say are some of the operational complexities that businesses might underestimate when they try to integrate directly with multiple operators across different countries?
It's a good question, and it's something where I think you can think a lot of these problems is there are things that most people think are easy but are really quite hard.
Yes.
And there's most things people think are hard but are really quite easy. And when you're kind of building a business and you're trying to make your way, a good place to be is to figure out like where is it that you can play in this, so you can do some of the things that people think are really hard, but you can actually find quite easy. And you can take advantage of the fact that some of the things that people think are really easy, are hard through the experience you have on the ground. So one of the things that people often underestimate is like, if you, again, I'll just take Orange Cameroon as an example. We could have picked any of the operators, but let's take Orange Cameroon as an example. They have a relatively small staff sitting on the mobile money infrastructure in Cameroon. They're very busy just keeping the lights on and keeping the tech infrastructure running. And there is an enormous pressure, an enormous amount of demand for people wanting to connect to the infrastructure and to set up wallets and operate. So even just the first step of actually getting a contract or even getting a contact from someone from the wallet operators can be tricky. It can take months to just get to the right person in the right building and get the right contracts and get the thing set up. But let's not assume that you actually already have set it up. The reconciliation of these APIs is also something that people often underestimate. Anybody who's been around on the continent and has been exposed to mobile money understand that it's quite a fickle infrastructure. It's very often there's delays in the responses, the wallet operators have downtime. So when you're trying to build financial infrastructure around something that's inherently quite unstable, you run into issues at scale. So what people often underestimate is they think, as long as I get the contract and I connect to the API and I build the integration, then after that, everything is smooth sailing and everything is easy. But unfortunately, what happens quite often is you have issues with reconciliation. So for instance, someone's sitting down on a Friday afternoon with his family and wants to watch TV, wants to put on a Disney movie, tries to send money to the TV operator to pay for his individual movie or pay for his monthly DSTV subscription. And he gets a receipt on his phone that the payment is done, but somewhere in the infrastructure and the plumbing on the telco side, something goes wrong and that information is lost. So the receipt is never sent to DSTV, so they don't know that he has paid and needs to receive the money. And then the first thing that guy does is, of course, he gets very upset and he starts calling into DSTV, and then DSTV gets this enormous amount of customer load and customer complaints for why the reconciliation is not done correctly, and that leads to unhappy customers. That's something we see quite often in the infrastructure, is the underestimating how you can build something that's really scalable up against a quite unstable infrastructure.
Thank you for sharing that. So we've talked about the infrastructure. So once the infrastructure layer is solved, the next challenge sometimes becomes the movement at scale and the cross-border. So cross-border settlement still remains one of the biggest challenges that we see, or friction points with regards to this space. What would you say are some of the other real bottlenecks that you're still experiencing today?
A real issue that people also tend to underestimate is just banking operations. We operate somewhere between 150 and 170 bank accounts across the continent. And there are so many bottlenecks with the traditional banking infrastructure that is just poor process, legacy process, outdated technology, and outdated human processes. And that becomes a real issue when you're trying to move money around, and you're trying to move money around reliably, and you're trying to move money around fast. You send money between one account in Cameroon. Sending money from one bank to Cameroon to another bank in Cameroon can take anywhere from an hour to 5 days. And when you don't have a very stable base to build on top of, that can create huge issues, because if you're trying to move money around different buckets, which you do a lot when you're running a payments company, you're moving money from merchants' accounts in the mobile money infrastructure to your own account in the mobile money infrastructure to the banks, and then over to another bank, and then to a liquidity provider, and then settling cross-border or the other way around, moving it back and forth. A huge pain point and a huge blocker to operating efficiently is the banking operations and being able to find and operate reliably with banking partners.
So are these bottlenecks caused just by process, or is it regulation, liquidity?
All of the above. I mean, just like a simple thing, like at the end of the month, the banks prefer to have the money in their accounts to prop up the balance sheet. So if you try to move money at the end of the month, it's slower. It only goes to at the beginning of the next month. So things like that can affect it, especially when you're moving larger volumes and you get a bit more into the enterprise banking of it, and you have some specific requests, but that person in the bank is sick. And then you have to find another person in the bank who can help fix your issue, and that person may be available the next day. But if you try and reach someone on a Thursday afternoon and that person is sick, and then Friday they don't show up for work, maybe Monday your issue gets picked up. And again, if you're just trying to send a transfer once a day or once a month to a friend, it's annoying if you know this happens Thursday and it then only comes Monday. It's annoying, but you can survive. But if you're handling millions of transactions every single day and you are moving billions of dollars around, those types of issues become an existential threat to your ability to serve your customers well. Like our customers don't care. If I tell them, hey, I would like to have given you your money on time, but unfortunately, Ruth from compliance at UBA in Douala is sick today, so maybe you'll get it in 2 weeks. Our customers, they don't care. It's not their problem. They need to have a reliable system that they can depend on, so they know where their money is and they know where their money is exactly when they need to use it.
Would you say that some of these challenges are maybe also caused by the increased demands or needs of customers, such as speed and also currency optionality?
Yes, I think it's. I mean, again, also, I don't think it's necessarily. It's not an African problem. I think banks generally across the world suffer from infrastructure that it's really hard to turn around. Like turning around really big legacy systems is very difficult. And I think that's why you're seeing in both the US and Europe and certainly also Asia, you see challenger banks and alternative financial infrastructure coming up really fast, because sometimes it's actually easier for the small guys to build a completely new system than for the big guys to turn around a multi-billion-dollar, 10,000, 20,000 employee ship. That can be really, really challenging. So you see that all over the world. It's not necessarily an African issue, but obviously in Africa you are under another level of pressure, which is just because the population growth is as it is. It's a strong population growth in this part of the world, increased economic activity, high GDP growth in a lot of the countries. Of course, that pressure on the infrastructure is very real. So you're seeing pressure from those angles that you don't have in a country like Germany, for instance, where there's practically no GDP growth. If you have a GDP growth of 6-7% and population growth on top of it, obviously that means that all the basic infrastructure gets increased pressure every year, and that includes the financial infrastructure.
You touched on something important there, which is the growth of infrastructure and GDP in Africa. So with that growth, are you seeing a growth in intra-African remittances in terms of Africa to Africa flows?
Definitely. Again, the big interest, big growth, and also interest that's really hard to meet. So intra-Africa trade, I think, still suffers enormously from legacy regulation. And it's not that the central banks don't want to fix it, but it's difficult. It's difficult to make complex problems to fix. But the technology is there. We see huge demands and have to turn a lot of people down. Like basically with our infrastructure, the way it works, I can take money from any cell phone on the continent that's connected to mobile money infrastructure, and I can send it to any other phone on the continent in the infrastructure, and I can do it instantly. So I can take money from any phone in Senegal and send it to any phone in Zambia, and I can do it. The money pops up instantly, but I'm not allowed. There's regulatory reasons why those transfers are under quite scrutiny by the central banks, and typically the regulation and the way that central banks look at money moving around is through a quite traditional lens of the traditional banking infrastructure. So they're not so accustomed to how does this work when money can move and be cleared instantly. Moving that conversation forward to the next logical step, which is stablecoin. Like what happens in a world where you don't need a third party to verify, and you don't need that trust link in the middle of transactions, but you can have direct third party less transactions across borders between individuals or between businesses. Like how do central banks protect their customers and their citizens in those situations? So huge interest for interbank trade, inter-Africa remittances, inter-Africa trade. And a lot of the flows are right now a little bit funny, a little bit in a gray zone, because people, they want to move on with their life. They need to push things forward, and the regulation is a little bit halting behind.
So you've touched on this slightly in terms of the growth. That growth has allowed you to expand and operate across, I think, around 20 regulatory regimes. So would you say the regulatory environment is becoming more harmonized, or is it still fairly fragmented?
It's hugely fragmented. I mean, there's Ghana and Rwanda, I think this year launched, or the end of last year launched, passporting. And we're still to see how that actually pans out in real life, how the licenses can be used across. But in essence, again, if you want to build a Pan-African payments infrastructure that makes it possible for inter-African trade to flourish and make it possible for people to trade across borders and send money across borders, you need to operate in a fairly large number of jurisdictions, and each of those jurisdictions has their own central bank and their own regulations. And there's some harmonization, but there's also huge differences from jurisdiction to jurisdiction. And still to this day, there is no other way than going to the central bank in every single country and filing an application and submitting the documents and waiting for that process, which is, there's no easy way of doing that. You need to do that if you want to build core infrastructure across the continent.
You mentioned that there's huge differences country to country in terms of regulation. So would you say the regulatory clarity in a single market is a huge competitive advantage in this space?
The blanket answer to that would be yes. I think anytime you want to build a business, or anytime you're trying to do anything, regulatory clarity is really one of the key things. Like, you just need to know, can I invest here? Will they change the rules next year? What will the landscape look like? If the regulator is constantly flip-flopping and constantly changing and constantly being vague about what might happen next year, it just gets really hard to build and operate a business with confidence. So even if the regulator is very strong, and if the regulator is creates a lot of guidelines and directions in the country for how they want the industry to look, that's normally actually quite okay, as long as you know that they don't change their view and change their mind next year. So it's fine. You can operate in a very regulatory strict environment, or highly regulated environment. And it's actually often quite nice, because then okay, this is at least the rules of the game. You just can't have them change their minds all the time. But I actually think most of the regulators across the continent are doing a pretty good job. I mean, most of these technologies are very new, and everyone is still kind of trying to wrap their head around what all this means for consumers. The rise of stablecoins, the rise of mobile money, the rise of e-wallets, the digitization of cash and money. It's something that's happened quite fast, and they have a lot of other issues that they have to struggle with, protecting their currencies, battling debt and conducting monetary policies. So I think they're actually doing a pretty good job, yeah.
Fantastic. So outside of regulation, when you decide to go into a new market, what would you say you look at or consider before making that move or making a decision?
For us, it's been quite easy up to now, because we've been very narrowly focused. We've just done mobile money. For the longest, we're 5 and a bit years in now, and for the first pretty much 4.5 years, we're just looking at mobile money. So we just made a list. These are the big mobile money operators. These are the countries where they are. And we just started at the top of that list, and we went down and just added the mobile money operators. At some point, we actually had our KPIs for the business, and our goals were, one year, we need to cover 75% of all the wallets, and the next year we need to cover 80% of the wallets, and the next year 85% of the wallets, and tracking how many of the wallets that we could cover, just looking at traditional telco-led mobile money. Now we've started expanding it into both banks and non-telco mobile money. So the non-telco mobile money would be the likes of like OPay in Nigeria and pawaPay in Nigeria, Wave in West Africa. They're kind of not traditional mobile money because they're not operated by the telcos, but they still, for all intents and purposes and for the customer, is very much feels and functions like mobile money. And now we're looking at stablecoins as well, of course. So when we're looking at new markets now, we're looking at, what are the kind of markets where our general product for payments fits in nicely? And those are kind of next up on the line, are probably more pushing into North Africa, but it's a quite new territory for us. We went to Egypt. It's a really cool place. Lots of very fun and interesting stuff happening in the fintech ecosystem up there. But again, very different market. And if there's one thing we've learned, it's definitely not to be naive about how difficult it is to enter a market that has a lot of really intelligent players already.
Interesting. As you mentioned, the amount of mobile money operators and demand drive your decision to go into new markets. We know that demand is driven by the business on the ground. So from your transaction data, which sectors would you say are driving some of the fastest growth that you're seeing in specific markets?
Across the board, whether you kind of morally object to it or whether you like it or not, sports betting is legal in most of the countries across sub-Saharan Africa. And sports betting is, by quite a margin, the largest sector of digital payments. I think a lot of the financial industry that exists on the continent exists in the payments companies in one way or another to service betting flows. And that's not necessarily a bad thing. It allows the companies to make some revenue that they can then invest to build the infrastructure that helps the broader economies and helps in other industries. But betting still is the main driver of traffic and volume for most of the payments companies across the continent. Other than that, remittance has come up really, really, really fast. That's one of the big things that has fundamentally shifted on the continent in the last 5 to 7 years, is the rise of remittance payments directly into people's phones. So where it used to be either quite tedious to banks or with like cash, to a large extent, like Western Union and MoneyGram and the more traditional money transfer businesses, the shift into digital payments to where people now send money straight into the recipient's mobile money wallet has just absolutely exploded from low single digits, probably about 5, 6, 7 years ago, to almost $100 billion this year. So that's an enormous shift that obviously changes everything, because when you've got this inflow of cash into the system, of course that cash then sits on people's phones and then they spend that on other things in the infrastructure. So that's been a huge shift. On the treasury side, the rise of stablecoins. Again, it's very difficult to operate treasury across many countries across the continent, and stablecoins have filled a very obvious gap there that's been present because of dollar shortages and again, just general banking inefficiencies. Stablecoins have really found a solid home in Africa. And I think that's also why when you see a lot on a global level, Africa is often at the top of the list of crypto adoption and stablecoin adoption and stablecoin volume movement. It's because it's really found a very solid use case, because the traditional financial rails are just so poorly equipped to handle the pace and speed and volume that needs to happen.
Fantastic. So you've touched on some of the trends or the exciting movements that we're seeing currently in the space. So if we look forward, what would you say is your prediction over the next 5-10 years? What would this payment landscape look like to you?
Well, I can tell you how we think about it as a business. There's kind of a few central pillars that I think are quite useful for us as we try and guide ourselves in setting our goals and building the business. The first is things always take a lot longer than you think. It takes a lot longer to build the business. So when we're thinking of the maturity of this business, where it's a point where either it could be sold off, or it could be listed, or it could be absorbed by another player, we're probably another like 10 years in. It's going to take us another 10 years. From the outset, we're like, okay, it's going to take 15 years to build a big business. So we're 5 years in now. It's going to be another 10 before it's at a pace where it's like, okay, this is a reasonable size. At that point, somebody looking at that business will evaluate looking into the future and will look at something like the next 15, 20 years. So what we really need to think of is the full scale, like the next 30 years. That's the environment as a minimum that we need to look at when we're building up the business and the kind of infrastructure that we're trying to build. So at the core of it, when we're looking at that, we're looking at, okay, Africa, which is the part of the world that we operate in, and we don't have any ambitions to be anywhere else, is it's hugely exciting for this reason, because, again, population growth is very solid here. There will be many more people in 10, 15 years, not less. The GDPs are growing, so there will be more money, not less. GDP per capita also grows, so people will have more money. People will be more online. They will not be less online. And there will be more digital payments, not less digital payments. These are all like very uncontroversial statements. They're pretty hard to bet against. So if you look at that and you're like, well, what does that look like in 10, 50 years? Well, our space in digital payments in Africa is obviously going to be a much bigger space. So that's the kind of base that we use for our assumptions and kind of where we're so bullish on the digital payments space in this part of the world is all the macro trends are just very strong. Now, what the payment space looks like, well, there will, of course, there will be some banking payments because the banking infrastructure is not likely to completely disappear. There will be a lot of mobile money because mobile money is just, for the majority of people on the continent, the primary financial infrastructure. And it has such velocity and such uptake and demand. And it's just a very strong product in general that it's quite hard to imagine that something like cards is going to come in and overtake mobile money and general day-to-day usage. There may be a little bit of cards, but not a whole lot. And then there's obviously, it looks right now, it's like there will be quite a lot of stable coins. So it's not like where we're looking at, like the payments market in 10, 15 years is going to be much bigger because of the macro trends. And it's going to have this composition of some banking, some mobile money, and some stable coins. So what we try to do is try to position ourselves in that space and be, okay, if we want to be a big payments player in 10, 15 years, these are the basic assumptions that we have to look at. I think particularly stablecoin is very interesting and it's going to fundamentally change the way finances is done on the continent. Again, because right now when you're transferring money between two people, you do need a third party, at least one third party, often two third parties, which is the bank. And all the bank does is basically just guarantee the other guy, I have the money. So when you're sending money from one person to another, all the banks, the real role of the bank is basically just guaranteeing and verifying to the other person that this money actually does exist. But when you put all that on the blockchain, you don't need the bank in the middle anymore. You can send transfers directly between two parties, and they are verified directly on chain. So you don't need that third party to verify or to guarantee that that transaction exists anymore. And that just very fundamentally changes the entire financial infrastructure, the speed at which things can move, and the necessity for a huge part of the infrastructure to look like it does today.
I know one of your visions is also to connect every mobile money wallet in Africa to one another through the world. For this to happen, I guess structurally, what needs to happen in Africa over the next 5 to 10 years?
Technically, we've done it. So I can take any phone in Ghana and take money from that phone and send to any phone in Uganda or any phone in Tanzania and send to any phone in Senegal. So we're already connected all the infrastructure. It's there. There's a lot that needs to be done on the regulatory side for it to be a place where, like, okay, you can just be allowed to freely do that. It's moving in that direction, but it's more like a regulatory challenge than it's a technical challenge. The technical challenge has been solved. And I mean, we're obviously not the only ones in the whole world who has done this. We have competitors, and some of them are very competent, and some of them have done the same. It's no longer like a technical issue to connect all the phones on the continent. It's a regulatory issue.
One last question.
Quote of the week.
As people, we often have quotes, mantras, proverbs, affirmations that keep us going when times are challenging or when times are good. Do you have one that you can share with us today?
Yes. I got one that I picked up from a friend of mine last week. Actually, I thought it was quite funny. It's kind of like a rip-off and a riff on the JFK quote when he's going to the moon, where he talks about. So it says, "We don't do it because it's easy. We do it because we thought it was easy." I think that's quite funny.
I like that.
It very much encapsulates the feeling of trying to build a business in the environment that we're in.
100%.
I think for most people, actually, that's the experience of building a business. It's euphoria or terror.
I agree. Nikolai, fantastic. Thank you. Our conversation. I think today we've explored quite a lot from what it really takes to move money across African markets and globally, and also that interoperability and what it actually means in practice, and the elements of treasury, liquidity, FX, and also how regulation is quietly shaping the next phase of African mobile money, fintech, the whole space in general. So thank you for joining us today. It's been an absolute pleasure, and thank you for sharing your experience, your knowledge, your wisdom with us.
Thank you for having me. It's been very nice to finally get to chat to you.
Thank you to everyone who has listened and stayed tuned to the podcast. If you've enjoyed this episode, please subscribe, share, or tell a friend about it. You can also rate, review us in Apple Podcasts or wherever you download your podcast. Thank you, and see you next week for the Unlocking Africa podcast.